Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of our InvesTips podcast. Today we'll discuss wealth planning, a cornerstone of comprehensive wealth management. As portfolios increase in size, they become more complex, with challenges such as valuing unique assets, managing illiquid holdings, navigating family dynamics, and handling cross-border considerations. So that's why proactive wealth planning is essential for protecting your wealth for generations to come. Joining me for today's podcast is my colleague Mike Tan, Global Head of Wealth Planning and Family Advisory at Standard Chartered Global Private Bank.
Thank you, Steve. We're having this conversation at the right time. With over US 124 trillion projected to pass to future generations, thoughtful wealth planning has never been more critical, especially since most families tend to lose their wealth by the third generation.
Yeah, and I guess what's interesting is that despite wealth planning being so crucial to passing on wealth and values, few families have a structured plan in place. So approximately 1 in 5 Asian families, for instance, have such a plan in place. So before we go any further, let's unpack what we really mean by wealth planning and why every family should think seriously about preparing for it.
You're right, Steve. Indeed, not many families are indeed prepared for it, right? In fact, wealth planning, I would say, typically involves determining a framework and setting up structures in order to pass on your accumulated wealth to future generations of your family or such other causes and beneficiaries, for example, charity. It is not only about your wealth when you're considering wealth planning, but it's also passing on your values and your visions, the legacy that you want to leave behind. With the right plan, you can actually maintain family harmony and ensure that your wealth stays preserved across generations. The big question for a lot of people is, what happens to my wealth after me? Right? And this is now, more important than ever because, firstly, a lot of families now face wealth planning challenges. There are many seniors who are aging alone, for example. Digital assets just makes planning, such as cyber risk and tax risk and cross-border holdings. All these issues make planning more complicated, and there are also conflicting succession laws that complex probate processes. Another area is philanthropy. This is becoming quite central to wealth planning conversations today because many investors, many clients want to leave an impact and build a legacy from their success beyond just benefiting their own families. And finally, the issue of liquidity. This is crucial to wealth planning because if wealth is tied up in real estate and private businesses, a plan should be put in place to ensure that there's sufficient liquid assets to pay for things like liquid estate taxes, legal fees, and so on without having to force any asset sales. Increasingly, preserving family harmony and ensuring future generations of the family understand the meaning and responsibility of what they inherit is also important.
So I guess this is not something that happens by accident, right? It requires a lot of thought and planning to do it properly. And obviously it's a very personal journey as well. So I guess a good place to start is by understanding the various wealth structures available. So let's start with something that many listeners may already be familiar with, trust structures. Now, I guess there's several types out there. Could you walk us through the main ones?
Sure, Steve, I'll be happy to do that. Now, as many people may know, a trust is a legal arrangement where the owner, usually referred to as the settlor, transfers assets to an entity that is managed by the trustee for the benefit of heirs or beneficiaries named in the trust document. Now, some people may contrast it with a will. So, usually a will takes effect after the grantor's lifetime. On the other hand, a trust can be set up and can operate during the lifetime of the grantor. So it offers better control and flexibility. The assets that are effectively settled in the trust generally will bypass probate proceedings, and it remains relatively private, and therefore it protects sensitive financial information. Trusts are broadly classified into living trusts and testamentary trusts, which I will go through, as well. A living trust is usually an arrangement where a grantor creates during their lifetime to transfer their assets. Now, you can set up a trust in different ways, and usually these are some of the categories or types that people will consider. Firstly, a revocable trust. This is where a grantor can change or revoke the trust at any time during their lifetime. You can still avoid probate using this arrangement, and it offers flexibility and privacy. On the other hand, an irrevocable trust would not allow the grantor to revoke the trust after creating it. In essence, the assets that are settled and transferred into an irrevocable trust are permanently transferred. The settlors and owners who are seeking better asset protection often will consider using this type of structure. Then there is also a discretionary trust. And in the discretionary trust, the trustee will usually be the one having the power to decide on the nuances of asset distributions to beneficiaries. And this is why we call it discretionary, because the trustee will exercise their discretion based on their assessment of the best interests of the beneficiaries in deciding whether to distribute the assets. One could also set up a charitable trust. So here is where assets are earmarked for charitable purposes, either during or after the grantor's lifetime. Again, this can be set up as a revocable or irrevocable structure, and it can also be structured to provide tax benefits, especially if it supports philanthropic goals. Of course, a trust can also be structured to provide asset protection for settlors, but they must be properly structured and managed as well. So this is very important. Now, one could also set up a testamentary trust, which comes into effect after the grantor's lifetime. This is usually created through a person's will, which is a legal document, and to ensure that assets are managed and distributed according to their wishes as stated in the will.
Okay, so that's a great sort of introduction to trust. I guess the next thing to cover is, potentially setting up a family office. So obviously that can help manage everything from investments, taxes, and governance, and to philanthropy as well. So can you just give us a quick sense of how these work?
Thank you, Steve. You're right. Family office has become a buzzword and a trend across the world in many jurisdictions. And in fact, many families use a family office as a platform for their asset and investment management. If it is properly structured, I think family offices do a fantastic job of managing complex portfolios, growing wealth across generations, centralizing governance, and ensuring that there's a high level of privacy for the families concerned. In fact, Asia is now a fast-growing hub for family offices. For instance, in Singapore and Hong Kong, we've seen a fourfold increase in the number of family offices set up since 2020. For instance, a family office can be set up as a single family office where a single family essentially uses it to handle their investments, deal with their taxes, estate issues, provide philanthropy alignment for the family's vision, and it can also take care of some lifestyle services that the family may need. On the other hand, some families may choose to group together with other families and set up a multi-family office which serves multiple families with similar purposes. However, the solutions for each family can be customized, and some control and personalization may be more limited, but it is still an excellent platform for these families to manage their wealth together. Some families also set up a family office virtually. It is leaner, costs are also lower, and some operations can be outsourced to specialists, which reduces the need for in-house staff and also reduces costs.
Okay, so I guess choosing a family office really comes down to the wealth complexity. The size of the assets being managed, I guess, has an influence as well. Your family needs and also a level of personalization you expect. Maybe just a quick comment on foundations.
Sure, happy to talk about that. Now, foundations are actually another simple way to manage wealth in the long term. Unlike a trust, a foundation actually owns the assets, and usually you will have a council that is set up under the foundation rules, and this brings a structure to the management of the assets and also reduces family disputes. One important thing as well is that it is a separate legal entity, so it does separate from personal ownership of the assets held in the foundation.
And maybe before we sort of move on to the process, just a couple of other structures worth flagging. So I guess in Singapore, families have started looking at this thing called a VCC, or variable capital company. This obviously offers a flexible investment structure which lets you pool multiple investments under one umbrella. You can add to or withdraw capital easy and clearly separate your assets through sub-funds. And so this can be very helpful from a multi-generational planning perspective.
Yes, indeed, you're right, Steve. VCCs have taken also quite a lot of popularity in Singapore, and in fact, we see quite a few multi-family offices using VCC. Another option that the family can explore is setting up a private trust company, or what we call a PTC. This is where there's a trust structure underlying, but there is also a trust company that's set up and operated by the family itself, and often involving family members and their trusted advisors. And this trust company will then provide trustee services only to the family and to their own trust. This gives the family a greater control over complex and operating assets, which therefore has become also quite a popular structure for some clients and families in Singapore and Hong Kong for long-term wealth transfer.
Okay, so I guess the common thread here is protecting assets, number one, and number two, ensuring better succession. I guess there must be some simpler strategies. We've talked about some of the more complicated and maybe for ultra-high net worth clients. But are there some simpler strategies for asset protection that don't require setting up complex entities?
Sure. Steve, I think I always try to tell my clients to start simple, right? I think starting at all is better than not thinking about the issue. Simple solutions offer quick wins. They also protect liquidity, and they do avoid, you having to set up unnecessary structures, especially if the family's objectives can be achieved with simpler solutions. In any event, families can also benefit from having clarity and control right away without having to set up complex vehicles to do so. So one option that one always has is to really gift during your lifetime, right? This way is the most direct and simple way of gifting. You can transfer cash, assets, property, business equity to the next generation, and such lifetime gifts can also bypass probate and avoid family disputes. The other way you could do this is by setting up insurance and savings plans, right? This could also help you to build a pool of liquid assets that heirs can use to settle estate taxes, legal costs, or other obligations without having to force sell family assets. In fact, life insurance is a very strategic tool for wealth planning, and it does provide immediate liquidity to heirs, especially in times of need. And often, because it bypasses probate and are protected from creditors, it is a solution that works quite often in many situations.
Okay, maybe one last thing to cover, and it's obviously, I sense whenever you talk, there's a real emphasis on tax and regulations in wealth planning. So given today's cross-border portfolios, I guess understanding unique tax laws, inheritance rules, and legal systems across different jurisdictions is increasingly critical. So what steps should investors take for proactive cross-border planning?
Thank you, Steve. Yes, indeed, tax is a very important consideration in order to ensure that tax complications are taken into consideration, and also that the assets are held in a compliant way. Many families these days have assets in multiple jurisdictions, and this could result in double taxation. Depending on the availability, sometimes tax treaties and credits can help to mitigate this effectively. The other issue that one needs to think about is forced heirship rules, which could override personal wishes. So for families with cross-border businesses or properties and assets, it is important to consult a wealth planning expert to structure a compliant succession plan that minimizes risk and navigate these complex local laws. The other issue that one needs to think about, as you said, is the fact that with multiple jurisdictions, there is possibility for asset forex fluctuations, inflations, macroeconomic uncertainty, which can potentially erode the value of your estate. So you can navigate these risks through currency hedging, geographic diversification, and investing in a stable, well-regulated jurisdiction. It is also important to note that these days, many countries have their own disclosure rules, and globally we are moving into a more transparent asset and wealth reporting regime. Any non-compliance with tax reporting rules may trigger penalties and even freezing of assets, and therefore it is critical to understand the jurisdictional requirements, automated reporting, and utilize available tax provisions to ensure that your assets are well structured. Several families work with international wealth management experts to handle these complex compliance and governance issues for them.
Okay, Mike, thanks so much for your insights. It's really interesting, right? I think from what I take from this is, look, two things, right? So firstly, you don't have to do this alone, right? So, this is complicated, right? And obviously, depending on your personal situation, it can get even more complicated, right? So firstly, you don't need to do it alone, but the second thing is start. Right, because the hardest thing to do in anything in life, we always say the same with investing, is to start. So just get started on this journey, and it's amazing how much progress you can make in such a short space of time. So with that, we come to the end of today's episode. Mike and I would like to thank our listeners for joining us today. If you'd like to know more about strategic wealth planning, please visit the link in the podcast description. I look forward to speaking to you again soon. Until there, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.